Assalamu alaikum friends, welcome to today's topic. Today's standard is IFRS 1. IFRS 1 is when an entity adopts an IFRS for the first time. So here we are going to study some issues when you adopt an IFRS for the first time an entity, how they have to report and recognize and all. And also what are the implications of it when you adopt IFRS. The reason is because when you're preparing a financial statements based on national standards, which is not IFRS, and now when you're making IFRS for the first time, you're making financial statements based on IFRS, there are differences, right? So because there are differences, there'll be some issues when you're comparing the two sets of financial statements, national standards versus IFRS standards. That's the reason that we have to know how to adopt it and and some adjustments that are needed when you're adopting IFRS for the first time. And this IFRS 1 is not there in your FR, right? Financial reporting. This is new for SBR. It's not a long standard, it's a short standard. We just need to go through few issues, that's it. Because when they ask a question from the point of accounting issues, they might ask IFRS 1. An entity might not have like for example, in the exam, you might be given a standard that a company is following a national standard. And now they're adopting IFRS for the first time. So what needs to be done? How should you present your financial statements? All these questions might be asked in a case study. So for that, you need to know IFRS 1. Okay. Now, there are 5 issues that needs to be addressed when adopting IFRS standards. Number 1, the date of transition to IFRS standards. At which date from which date are you using IFRS standard? Number 2, which IFRS standard should be adopted? That means previously you have been using some national standards. Now when you're adopting to IFRS standards, how do you adopt? It should be something similar to that standard, the national standard. Right? When you're adopting IFRS standard, that IFRS standard should be somewhat similar to that national standard. Okay, we'll definitely do a question on this. How gain or losses arising on adopting IFRS standard should be accounted for? There will be some gain or loss when you adopt to IFRS standards for the first time. So how do you account for that gain or loss? Number 4, explanations and disclosures to be made in the year of transition. The year when you're making the transition, you have to explain that now you're adopting IFRS standards and why you're adopting IFRS standards, and also you need to disclose the exemptions available. Yes, there are some exemptions which you need to disclose. Date of transition. What is date of transition? That is the beginning of the earliest period for which an entity represents full comparative information under the IFRS standards. Your financial statements will be fully under IFRS standards. In its first financial statements produced using IFRS standards, that is your first set of financial statements, you are using full IFRS. If an entity adopts IFRS standards for the first time for the year ended 31st December 2008 and presents 1 year of comparative information, then the date of transition is what? This is the date of transition. 1st of Jan. Because he's making, he adopts IFRS standards for the first time for the year ended which one? This one. It should be a year before that. That is known as date of transition. Okay, that is the first day of the comparative period. You need 1 year to compare also. So the first day of comparative period, that is known as date of transition. So it will be 1st of Jan 2007, 1 year before 31st December 2008. 2 years before, sorry, because 1 year will be 1st of Jan 2008 then. So that you said that you can compare the 31st December 2007 with 37 2008, the two financial statements. An opening IFRS statement of financial position should be produced as at the date of transition. Okay. The statement need not be published, but it will provide the opening balances for the comparative period. Yes, you might not publish it, but you need it. You need that because you need the opening balances for the comparative period. You understanding? Now, the question comes, which IFRS standards should be adopted? The entity should use the same accounting policies for all the periods presented. This policy should be based solely on IFRS standards in force at the reporting date. Next, a major problem for entities preparing for the changeover is that IFRS standards keep changing. That's an issue, right? Therefore, an entity may apply an IFRS standard that is not yet mandatory if the standard permits early application. Some IFRS standards, even though they are not mandatory, they allow early application. You can start using it early before it is made mandatory. So it is better to use that so that later when you change over, it will not have so much impact on your comparative financial statements. Okay. IFRS 1 states that the opening IFRS statement of financial position must. So this is the important thing from here to here. All this is very important. You must recognize all assets and liabilities required by IFRS standards. You must not recognize assets and liabilities not permitted by IFRS standards. For example, earlier using national standards, you have been recognizing assets and liabilities, but from the year when you are using IFRS standard for the first time, you cannot recognize if it is not permitted by IFRS standard. Reclassify all assets, liabilities, and equity components in accordance with IFRS standards. You will need to, for example, according to your previous standard, you have been, let's say, gap, right? You have been recognizing something and something as an asset. Now you need to reclassify it under IFRS standards. So measure all assets and liabilities in accordance with IFRS standards. Okay. An entity's estimate of as the at the date of the transition to IFRS standards should be consistent with the estimates made for the same date in accordance with the previous gap, unless evidence exists that those estimates were wrong. That means the entity's estimate at the date of transition to IFRS standards. This should be consistent with your previous gap's estimate. Now, how are you reporting the gain and the losses? So when you adopt the IFRS standards, okay, any gain or loss you are having based on that, it should be recognized directly in retained earnings. Okay, they are not recognizing profit and loss. It goes to retained earnings. Now, explanation and disclosure. They must explain how the transition to IFRS standards affects their reported financial performance, position, and cash flow. Yes, definitely it will affect. And when preparing his financial statements under IFRS standards, an entity may identify errors made in the previous year. So how should you do it? You have to correct those errors. The correction of these errors must be disclosed separately when you're making an error. When preparing statements in accordance with IFRS standards for the first time, the fair value of property, plant and equipment, intangible assets, and investment property can be used as the deemed cost. Because definitely we might not know the fair value initially when you're first adopting IFRS standards. So they can be used as deemed cost for property, plant and equipment, for intangible assets, and for investment property. That means under IS 16, IS 38, IS 40. So if so, the entity may disclose the aggregate of those fair values. They can aggregate the fair values and disclose also. And the adjustments made to their carrying amounts under the previous gap. So you must disclose this. Now some exemptions. IFRS 1 grants limited exemptions in situations where the cost of compliance should outweigh the benefit to the user. Whenever the cost is more, you are exempted. For example, so they have given some examples. Previous business combinations do not have to be restated. Previous business combination means before adopting IFRS standards. Whatever you have done, the business combination. Now after adopting IFRS standards, you don't have to restate it. It is exempted. That means as it is, you can carry forward when you are adopting IFRS rules for the first time. An entity can choose to deem past translation gains and losses on an overseas subsidiary to be nil. Here you have a choice. For example, you have an overseas subsidiary, right? And when you were translating their financial statements, you were having some translation gain or losses in the past. Past means, see, always past is referred to as before you adopt IFRS standards. Now, after adopting IFRS standard, you will be taking it as nil. That means there will be no translation gain or losses. Third, an entity need not restate the borrowing cost component that was capitalized under previous gap at the date of transition. What happens? You don't have to restate it. You take it as it is, whatever it was there under previous gap. The borrowing cost that was solely capitalized. Okay, borrowing cost is explained under IS 23. Now, entities that have historically prepared their financial statements in accordance with local GAAP are increasingly adopting IFRS. Why is it so? If you see today, more and more companies are now moving towards IFRS. They're adopting IFRS, leaving their local gaps and all. This is often welcomed by current and potential investors because they seek investments from across the world. Okay, the increased adoption of IFRS standards helps investors to compare the position and performance of an array of different entities. One reason is comparison. It allows you to compare with other entities who are using IFRS standards, enabling them to make more informed decisions and reducing the risk that they're exposed to. There is a time and cost burden involved, definitely. Whenever you come to new standards, you first have to go through the new standards, you have to learn. And on the paper wise also, it's documentation and all, it's costly, right? However, it is generally believed that this is outweighed by the benefits. So they believe benefits is more than the cost of IFRS standards. Now, so this is the last section before we do a question on IFRS 1. IFRS 1 just has one question. IFRS 1 does not have so many questions, and this is not a question which comes in exam very regularly. So you can just briefly go through this. Okay, nothing to buy hard here. So implications. What are the implications when you adopt to new accounting standards? You are moving from your local GAAP to IFRS. You have to carefully plan and consider this, whether it is beneficial for you to do it or not. Okay. Entities that have accounted under IFRS for many years, what about they? They still need to be aware of the implications of adopting new accounting standard. After all, the board regularly revises existing IFRS and issues new IFRS standards. The ones who have been using IFRS standards for many years, even they have to be careful of any changes because IFRS standards does not stay static. They keep on changing. They're very dynamic. Whether it will be beneficial for you to stay with IFRS standards or you have to move away from it, you should always consider these issues. Okay. So before any entity adopts new accounting standards, they should consider this following. They just don't go and start using IFRS standards. They definitely go through this, consider this, and then they think if it's beneficial, then they adopt IFRS standards. Otherwise, they don't. One is transitional guidance. Many newly issued accounting standards provide guidance on how to transition from an old accounting standard to a new one. For example, IS 17 before leases, now it was changed to IFRS 16. If no guidance is provided, entities should apply IS 8. Okay, IS 8 is a very important standard because it is relating to when you change your accounting, change in accounting policy, change in accounting estimate and error. If no guidance is there, you apply IS 8. Okay, but some they give guidance on how to go from the old to new one. For one example is about leases, very good example. IS 17 to IFRS 16. But if not, no standard is there, go by IS 8. Next, bonuses and performance related pay. So adopting new accounting standards will affect profit. Okay, and because of that, your bonuses might get affected. That's why such schemes may need to be redesigned. IT system. This might not be capable of dealing with complex recognition. For example, IFRS standards have so many complex recognition, measurement, disclosure, and all those things. So you have to see whether IT system is capable enough to do that or not. Deal with this complex recognition, measurement, disclosure requirements of new accounting standard. Covenant on loan. A key financial statement ratios might deteriorate as a result of implementing new accounting standard. Yes. If you implement a new accounting standard, it might deteriorate your ratios. So loan conditions may need to be renegotiated with the bank to stop borrowing becoming repayable. First, you have to look at that before you apply for us. EPS. Requirement of a new standard might reduce the profit, which will also reduce EPS. Right? EPS is also a very main financial ratio, which is mostly used by the investor and the potential investors to see the performance of the company. Perception. Analysis may view the move the IFRS standards or the early adoption of a newly issued standard favorably. That means they think that when you move into IFRS standards, it is considered more favorable. It's just a perception. People think that when I move to IFRS standards, I will be considered or I will be given more professional treatments regarding the ones who have still not been adopting IFRS standards. Because many organizations throughout the world are using IFRS standards, so it becomes easy for them to compare and analyze. Knowledge: the entity may need to spend time and money on training existing staff or recruiting new staff. Right? It's very easy to understand. You definitely need knowledge and skills. You need to learn those new IFRS standards, how to apply them, and you need to teach the staff also. So it takes time and it takes money. So now let us summarize what we went through in IFRS 1. So the 5 points to consider are this: the date when you are going to transition is going to happen, and second is which IFRS you should adopt. The third is gain or losses. They are recognized in retained earnings, not in profit and loss. And then the explanation and the disclosure that is made in the year of transition. Make sure that you know what is this, what is the year of transition. You should know this. That you should be able to identify. Okay, and also some exemptions are available when you adopt from uh, an, a local standard to an IFRS standards. Now, what are the implications? So these are some implications. Training cost is there. You have to see your IT system, planning project, whether you have a plan. Then also you have to look your debt covenant. You have to calculate your performance related pay. Anything that is based on profit, you need to recalculate it. And also you need to communicate this expected changes with the analyst. Okay, whether they think it is beneficial or not and all. So now let us start this test understanding 1 before I finish IFRS 1 and go to the next standard. NET is a company that used to prepare financial statements under local national standards. Their first financial statements produced in accordance with IFRS are for the year ended December 2005. And this will include comparative information for the previous financial year. Its previous GAAP financial statements are for the years ended 31st December 2003 and 2004. The data are unsure about the following issues. So there are 3 issues, and in accordance with IFRS 1, how the above issues should be dealt with. First one, NET received 5 million in advance orders for a new product on 31st December 2003. That is when they were having the local GAAP. These products were not dispatched until 2004. In line with this previous GAAP, this 5 million was recognized as a revenue. So now which standard you have to use? IFRS 15 to see whether this will be recognized as a revenue still or not when you adopt your IFRS. So let us go through the first one. So the comparative figure, you should know that comparative figure should be presented for this because your year end is 31st December 2005. Right? First set of financial statements you produce using full IFRS was December 2005. That means comparative will be a year before that, 31st December 2004. So comparative figures prepared under IFRS standards for the year end 31st December 2004 must be presented. Next, date of transition is therefore, so this is the date of transition, exactly 1 year before your financial statements, which are the comparative figure. They were prepared on for the year ended 31st December 2004. So 1 year before that will be your date of transition. That is 1st of January 2004. An opening IFRS statement of financial position. This is known as opening IFRS statement of financial position must be produced at this date. So some of the accounting policies that NET uses in its opening IFRS statement of financial position differ from those that is used as the same date using its previous GAAP. Okay, the resulting adjustments arise from events and transactions before the date of transition to IFRS, and therefore NET should recognize those adjustments related to retained earnings that we know, profit and loss. Now let us go to the transition 1 about the revenue. So the sale does not meet the revenue recognition under IFRS 15. Why? Because control of the asset has not been transferred from the seller to the customer. So in the opening IFRS statement of financial position as of 31st Jan 2004, a contract liability should be recognized. It's a contract liability. And the 5 million loss on recognition of this liability should be accounted for in retained earnings. It's a loss, so it will go in the retained earnings. Because earlier you have recognized revenue, now it's not revenue anymore, it is contract liability. Therefore, it's a loss now when you recognize a liability. So this will go in retained earnings. Okay, so you definitely need to go through IFRS 15 if you still didn't understand why it is, to know more about IFRS 15 if you want to know about this contract liability and all. Because if you see here, the products were not dispatched until 2004. That means it was not there in the control didn't pass to the customer. It was still there, so you cannot recognize revenue. Now let us go to the second transaction. A restructuring provision, that is IS 37. A restructuring provision of 1 million relating to head office activities were recognized at this date in accordance with the previous GAAP. This does not qualify for recognition as a liability in accordance with IS 37. So clearly they told it's not. Now what do you need to? So what do you need to do for that? The provision does not meet the criteria in IS 37. So in the opening IFRS statement of financial position as at 1st of Jan 2004, this should be derecognized. So the 1 million gain on derecognition of this provision will be accounted for in retained earnings. So again, why? Earlier it was recognized as a provision, so provision is an expense. Now you are derecognizing it, so now it will be a gain. So that gain will be recognized in retained earnings. We told it will be recognized in retained earnings, whatever the gain and loss. Now the third transaction. Net mid estimates of accrued expenses and provisions at 31st December 2003. Some of these estimates turn out to be understated. Net believes that the estimates were reasonable and in line with the requirements of both its previous GAAP and IFRS standards. So no amount has been given, but they just told it's understated. So although some of the accruals and provisions turned out to be understated, not concluded that these estimates were reasonable. Net concluded the estimates were reasonable and therefore no error has occurred. That means you cannot say an error has occurred because estimates were reasonable. So here they are talking about estimate. Which standard? IAS 8. So in accordance with IAS 8, this issue should be accounted for prospectively. Why prospectively? Estimate. Whenever the estimate is there, change in estimate, it is dealt prospectively. Prospectively means you don't go back and change in the past, but in the future you change the you adjust the figure. Therefore, the additional expense, because they told is underestimated, right? It turns out to be underestimated, some of the expenses. So that means there will be some additional expense. This should be recognized within the profit and loss. Prepared in accordance with IFRS standards for the year ended 31st December 2004. For 31st December 2004, yes, you can write in profit and loss account. This is not at 1st of Jan 2004. Not like the other two transactions. It went in the opening statement of financial position. That's why that gain or loss you recognize under retained earnings. That means there were some differences with the local GAAP and with the IFRS. That's why that difference, that profit and loss goes to retained earnings. But the last transaction, there were no difference. No error has occurred between when you adjust to IFRS standards from the previous local GAAP. Okay, if you read the third transaction, they believe that the estimates were produced in line under both GAAP and IFRS standards. So the gain and loss that time will be recognized in profit and loss, not in retained earnings. For 31st December 2004, in accordance with IFRS standards only, that additional expense. So that's it for IFRS 1, and see you in the next standard.